this chapter, we talk about process costing. So these are your learning objectives. So again, we kind of had this example when we were comparing our product costing, but process costing is where we're just making like the exact same product over and over again through a continuous production cycle. So like food processors, so I gave the example of like Coca-Cola, or potato chip manufacturers. Again, it's just the same product going over and over again, but they also say oil refineries, paper, like copy paper, chemical processors, an aluminum smelter. I'm not even sure what an aluminum smelter is, but obviously uses process costing. So then now we're going to group the costs not by specific job, but by department or process. So again, now they're saying this is different than what we just did in the last chapter, where we had specific products that we were making and applying costs to them. Now we're going to use processes. So here is some examples. Again, like I said, Pepsi, aluminum, gas, Hershey's chocolate bars. Those are all things you just make them continuously versus our job order costing, where it is a specific movie, a specific design of shoe, a specific advertising company that we're working for. So when, again, we're making the comparisons, we are still recording and summarizing our product costs. We're still using direct materials, direct labor, and factory overhead. We're still allocating that factory overhead. And we're still using our materials, our work in process, and our finished goods, and they will flow through that. And we're still trying to make, again, product cost information. So that, again, now it's just going to be like looking up at the above, graphic. We're going to go by department. So we've got our mixing department, and then we're going to have our packaging department. And then again, this is an example of making ice cream versus the guitar, where we had direct materials, direct labor, and overhead, and we're going in there by job number, and we're producing our finished costs. So the process is basically the same. It's just how we get there is a little bit different. But we're still accumulating those costs into work in process. But then now, instead of having job cost sheets, we're going to have in the process cost system, we're going to be using our work in process, and the sum in that process is going to go to the next department. So it's not going to be as specific as the job order costing was. So I'll let you read that example. So then again, our materials go into the mixing department. From the mixing department, they go to the packaging department. From packaging, they go to finished goods, but they'd have to be so far along to get to those different processes. So then look over this slide for a second. So again, it's showing you the same T accounts, but the flow is a little bit different. So now we're going to go from materials into our work in process mixing department. So direct materials go in there, direct labor goes in there, factory overhead is applied to the mixing department. Then after they're done being mixed, they're going to transfer over into the packaging department. So then there'll be a cost of units transferred, but then notice, okay, like this was the ice cream example, there'll be more direct materials because now we need the cartons that ice cream goes into it. So then there'll be additional direct materials added. There'll be the cost of the actual ice cream that's transferred from the mixing department. There'll be more labor added to put them into those packages, and then more overhead applied. Then once they're all packaged, they'll go into finished goods. From finished goods, they'll be sold out to cost of goods sold, and then that'll go on our income statement. So it's a little bit more detailed just because, again, we're going through the phases, these different productions, and then we'll have more costs and more labor added to each one of those. So then now where it gets a little bit trickier in this process costing is what they call these equivalent units of production, because we're not completely done as we move from one process to the other, but we want to say how And then we want to value our inventory to say how far done are we. So we're kind of going to go through those different types of things. Then we'll have our cost production report. And then our cost production report is going to again show us how we move that inventory. So we go back to like the first in, first out, and the last in, first out methodologies. So again, first in, first out, last in, first out, or average cost. So hopefully you remember those back from a earlier chapter in your prior accounting course. So here we have the mixing department, and they give us the data, what was in our beginning inventory in this mixing department. So we had direct materials, and then the conversion costs. So that's like our direct labor and our overhead, the stuff that we're using to convert those direct materials into, again, if it's the ice cream, taking all those raw materials that go, or ingredients that go in, how far completed are they? So they're in there. We've had some labor, we've had some overhead, and we're estimating that they're about 70% completed at the beginning. So then we add, we add more materials that come in, more labor that is used, more overhead applied. So these are our total units to account for. So then we're either going to transfer them out to the next processing area, or we are going to still have them in the mixing department. So it tells us that 62,000 gallons are done. 3,000 gallons are still there, and they're only 25% completed. So then we look at it to say, okay, what are our units? So we had 5,000 in our beginning inventory. We received 60,000, so we have 65,000 gallons to account for. So then so this is our total. So 5,000 is the beginning. 57,000 gallons were started and completed, and then that left 3,000 in our ending inventory. And again, they're at different stages, so it's kind of trying to show you how far in the completion they are. So 5,000 that was in the beginning, and then 57,000 was started and completed. So then we have 62,000 gallons that were transferred out, and then there's 3,000 left. So then again, I'll let you look through that exercise. Then our next step is to figure out our equivalent units of production. So the whole units that were started into production, and then now we're saying, okay, but how far along are they? So we've got 1,000-gallon batch of ice cream. It's 40% complete in the mixing process, so it's only 40% complete with relationship to those conversion costs. So it's 100% complete with relationship to materials, because all of the materials were transferred over, but only 40% complete for conversion. So again, you can have different levels, again, depending on the stage they're in. So like it says there. So basically, a lot of times our materials all come in at once, but then the conversion costs are going to be spread over a little bit longer period of a time. So then when we map out those equivalent units of production, we say, okay, we had the 5,000 beginning, and there was, those had all the materials already added to them before in the month of June. Then we started the 57,000 during the month, and those had 100% of the materials. We have 62,000 that were completely completed and transferred out. And then we have 3,000 left that are 100% complete related to materials. Whoops. So 100% complete related to the materials. So then our step 2, though, is to figure out, now what about the conversion costs? So our beginning inventory was 30% complete at the start of the month. in relationship to conversion. What we started and completed, again, it's all done, would be 100% complete with relation to conversion. And then what's remaining is only 25% complete. So then notice as you go across the columns, you're just multiplying. So the 5,000 times the 30% gives us 1,500 equivalent units. All of them, all of it that was completed is 100%. Then again, that is the total that got transferred to the next department. And then the 25% times the 3,000 is what's left. So then that gives us our equivalent units of production. And again, here it kind of shows it graphically, trying to show you that there's a piece of it that was, again, this is that's still left and it's not completed. So then we're trying to eventually get to, well, what's our cost per equivalent unit? So we'll take our direct material costs divided by those equivalent units for direct materials, our conversion costs divided by our equivalent units for conversion costs, because again, remember, those are going to be different. So for this, because all the materials are added at the beginning, we have a full 60,000 gallons to allocate for. The conversion, the labor, and the overhead come in at different rates. So there's only 59,250 equivalent units to account for. So then we will allocate those out to our product costs based on these rates. So $110 per gallon is the total materials divided by the 60,000 gallons. Again, these were our total costs. So then our total direct labor and overhead, 17,775. Divide that by the equivalent units to get to a price per gallon. And then now that we have that price per gallon, we're trying to allocate it out. So then we've got our direct materials for the 5,000 gallons. We've got conversion costs of 5,000 gallons, again, 70% completed. And then our direct material cost then for the 60,000 gallons, and then our direct labor and our factory overhead applied. So these are our total production costs. So then when we are going to allocate those, we had 5,000 in our beginning, and we're trying to figure out what is our total cost for all of those. So then now we're going to take the 5,000 and we're going to multiply that times our $1.10. And then our conversion cost in this case, so there's nothing in our in-process inventory. So then our conversion costs are the 1,500 times our 30 cents. Let me just circle back here real quick. That was the example exercise. All right, so here's those totals. So the $1.10 per gallon, the 30 cents per gallon. So now that is what we're allocating out here. So the $1.10 and the 30 cents to come up with our total costs. And then they will be our beginning inventory plus our units started and completed. Though that will be the total cost that's transferred to the next department. And then the see. So we're still okay. So we're still allocating out these costs, right? So the total cost transferred to the packaging department is here. And then now the 3,000 gallons that are in process at July 31st have incurred all of their direct material costs. So the 3,000 gallons times that $1.10, that's how much is in our direct materials. The $3,000 are only 25%, or sorry, the 3,000 gallons are only 25% completed in relationship to direct labor and overhead. So if you take the 25% times that 3,000, that should give you the 750. So we'll double check that though. So 3,000 times the 0.25 gives us the 750 gallons. So that's where that comes from. And then this was the rate that we calculated back on step 3, the 30 cents per gallon. So then that would be our total cost that is in our ending inventory. So again, we've got it mapped out from our beginning inventory, what was started and completed, and then what's left in our ending inventory. And then we've accounted for the whole $90,000. And again, I'll let you look at the examples on your own. Then now we prepare the cost of the production report. So again, it's a little bit more confusing than our product costing because again, we're mapping out those equivalent units. So this column gives you the whole units, and then this is saying that, okay, well, how are those allocated? So 5,000 beginning inventory had all the direct materials already included, so there's nothing in this current period that's the month of July. But then they were 70% completed at the beginning, so that would leave 30% still to be completed. Then the entire 57,000 that we started and completed is 100% done with materials, 100% done with conversion. Then our ending inventory is 100% done with materials, and then only 25% done with conversion. So then that's how those are mapped out. So then we have our total equivalent units from a material standpoint and then a conversion standpoint for the month of July. So if we're using our first in, first out methodology, it means the first stuff sold or processed is the first stuff that's going to get moved out into the next department. So then let me see here what we've got. So these are our same costs that we've always had. This is how we've mapped it out for the month. Then we're going to go down here and then again map out the based on that first in, first out. So the first ones would be our beginning inventory, then what we started and completed, and then that leaves us our ending inventory. So the journal entries, we go as the materials are purchased, they're going to debit our materials and then credit accounts payable, assuming it's on account. As we transfer it, it's going to go out of our materials into the different departments. So into the mixing department, the cartons and those kind of lids are going to go into our packaging department. And then if we have indirect materials, it'll go into overhead. But then notice now, not only is our work in process grouped by what department, our overhead is grouped by what department it is, whether it's mixing or packaging. So a little more details. Then as labor is incurred, that's going to go into our work in process, either mixing or packaging. As any other type of overhead, in this case it's depreciation, comes in, it's going to go into the overhead based on, again, what department it's in. And then as we allocate that overhead based on those rates, we're going to charge it to the mixing or the packaging and work in process, and then credit the factory overhead mixing or packaging. Then as it moves from from mixing and goes into packaging, we'll credit the mixing department and then we'll debit the work in process packaging. So again, it's moving through the flow, but we've got the two work in processes. Then when it comes out of packaging, it's going to be finished goods. So then we'll credit our work in process packaging and then debit our finished goods. And then as it comes out of finished goods, it's sold. So we're going to credit our finished goods and charge it off to our cost of goods sold. So again, here shows you the flow, but we'll go from materials into work in process mixing. Work in process mixing goes into work in process packaging. Work in process packaging goes into finished goods, and then that is where it's sold out of. So then this shows you the ending inventories at the various levels. And then this gives you an example of seeing that all work through. Then we'll get to our production report. Again, where we've got our showing what is included in our beginning inventory, and then we calculate out the new cost per unit and our new conversion cost per unit. And then again, see, those are a little bit different. So we can see that they've changed a little bit through from June to July. And then we're going to allocate it out based on the costs that were incurred. And then in this case, we're focused on the blending department. So again, we're in a different type of a company, but our direct materials, our direct labor, energy cost, repairs, tank leaking, our units completed to come up with what our unit cost is. And then this is looking at it as a per unit basis. Again, that might help management to maybe make some decisions looking at it in that direction. So again, they would say, hey, we should probably look at this. Like, why is there such an increase in our energy? Why are these tank cleaning costs so expensive? Because again, looking back at those are the ones that jumped out at you, 25% and 33%. They looked very different between those 2 months. So those indicate that something management should probably look into. And then our yield is our quantity of output per quantity of input. So the higher the better, you know what I mean? We would want to yield out most of our product. If we aren't, that means we're scrapping too much. And then again, there's an example exercise. Lean manufacturing means we want to have the best product that we can have, but we don't want to have a ton of inventory. We don't want to really be bogged down. We want everything to flow real smoothly, so we're getting the materials we need, producing them and getting them out into finished goods and into our customers' hands as quick as possible. Okay. So then here is an example of our traditional production. So we could have, again, we're making a chair. We could cut the wood to its specifications. Then we've got to drill it again to where all the screws are going to go in. Then we're going to sand it. Then we're going to stain it. Then we're going to varnish it. Then we're going to upholster the seat cushions. And then we're going to put the whole product together. So we could have a variety of different departments that are working on that same product. And eventually it all comes together into our finished good. So in a lean production, we're going to try to kind of maybe combine some of those. So we're going to have one group that cuts, drills, and sands, maybe like all, I don't want to say at the same time, but in a process that it goes much smoother rather than moving it from the cutting section to the drilling section to the sanding section. Then the next group is going to stain and varnish. And then the third group upholsters the item and assembles them. So it makes it a little more streamlined and a little more efficient. So that's ultimately kind of our goal. And then this kind of, again, just gives you that the product is going to be like pulled through so that we are trying to increase our efficiency of our operations. And then it'll move just in time to get to that next level, whether it's sold or the next level of the process. Our weighted average cost method is how we assign costs. So if we have our direct materials and we have 2 manufacturing departments, so we have the costs that we started with, the costs that were added, our labor costs added, and then we're going to have our costs transferred. So what we're going to do is we're going to come up with a weighted average. So let's get to where. So if we've got 65,000 units to account for, and we have our equivalent units, again, saying that not all of those were completed in relationship to our conversion costs. So we want to get to the point, though, where we've got our total production costs and we're dividing them by our equivalent units. So that is going to give us our weighted average cost of $1.42. And then that's how we're going to value what product we have. So the 62,000 gallons that were completed, we're going to charge off at this weighted average cost. What's left in our ending inventory, again, only 25% done, is also going to be charged off at that weighted average cost. And then here again, just kind of shows you that mapped out and how those costs are assigned. Okay, so then that is our process order costing. So you can see it is a little more detailed than our job order.